All right, July 9th, Tuesday. Couple couple things I want to remind you guys. Number one, July 9th, or I'm sorry, tomorrow, FOMC minutes. And before that, Powell gives his semi-annual testimony in front of Congress tomorrow, Wednesday, 9 Central. Could be a pretext that's released prior to that, but right at 9 o'clock, at the very least, they drop down the wires, all the bullet points of what he's going to say. He gives the testimony, and then it's a Q&A. Sometimes during the Q&A, it could be kind of choppy, and then you're going to move after. If he says anything that's an outlier, it could move the markets. Once in a great while, the chairman's testimony moves the markets. Once in a great while. And we're kind of in a situation where they're not going to go 50 because of the strong unemployment report, non-farm payrolls on Friday, but they're 100%, 95% going to go a quarter at the July 31, August 1st meeting. That's what's priced in. So let's move into today. Today we open up lower. Gap open lower, 12 points below yesterday's close. We open up even 7 points below yesterday's low. So what happens on a gap open lower day is one of two things. We go up or down. If we go down pretty fast and open drive lower, it's really bad for longs from yesterday because they had no chance to get out. And they're usually pretty stuck. If we open up and drive a little higher, then there's a chance to fill that gap to yesterday's low and even maybe yesterday's close. So you got to be careful fading that rally. If you don't catch the rally right after the open, which I didn't, then you got to be careful fading it. You could fade it, maybe sell it if it filled somewhat of the gap to maybe back down to where it opened. And that was the thought process. After the rally, here's what you're looking at. You're looking at the market chop back and forth after the first 15 minutes. We rally from 66 quarter to 73 even in the S&Ps. And now we're creating this consolidation box. They're duking it out. Well, at some point, we're going to break out to the upside or downside. 71 half, to me, became a moment where buyers stepped in and the son of a gun couldn't go up. Punch a guy in the face and he doesn't flinch. Or he wet his pants on the playground and everybody laughs at him. This wasn't good for a big winner, though. Let me show you. Let's replay it. First of all, listen to the sound of 71 halves being bought and the green edge zone flash. Might take a minute or two, so I might have rewound it too much. But as it's doing it, as it's working, there's a couple things we know at this point. We know we just rallied from 66 quarter after the open. We filled a little bit of the gap to yesterday's close, or a 72, 73 even area. There it is. You hear that? One half. That's 71 halves on the right-hand side that are aggressively being bought at that moment versus the 71 quarters that are bid. Let me play it. It quickly goes bid and then offer. It goes bid, I know, I could tell you right now, because 5 traded right there at 71 3/4. Well, you can't trade 5 at 71 3/4 unless the 71 halves are at least bid, correct? But it goes offer right away. So buying doesn't get it even to go bid for any period of time. That is a quick win moment if you're looking to sell it. This doesn't have to get you bearish, but if you are bearish, if you're looking for, all right, we've come into resistance at 72, we filled that bit of a gap. Now let's break this thing down back to the open. All right. Now you're bearish. That could be your win moment to execute and then start to also assign where your risk is above. All right. The best thing, let me pause it again. The best thing that could happen when you put a trade on is what just happened. An immediate 3 or 4 tick head start. Because now you go to the crap table with the house's chips. Right? It's like you're in Las Vegas and the hotel left you some complimentary chips, $5,000. So you go to the table with their money. You didn't even have to win it. You went to the table with their money. You're playing from a position of strength when you pick locations that go your way sooner rather than later. It doesn't have to happen every time, and it's relevant to what you're looking for as far as targets, as to what and how quick it goes your way. Because I got news for you. Anybody listening to this, that you're looking for 10-point winners, 8-point winners, 5-point winners, or 20 tick winners in the S&P minis, do you think you're going to risk 3 or 4 ticks to try to make 5 points? I don't know what world you're living in, but it ain't this one. It ain't going to happen. You have to have proper risk-reward ratios. I know everybody like to have 10-to-1 winners to losers, but I like to have 2 blondes and a brunette. Doesn't happen anymore. So you got to be careful on your expectations. All right, so move on. Let's play it.
Even quarter.
Goes down. Nice little 3 or 4 tick head start. I scaled out of something, but this wasn't a winner that amounted to anything. And the reason is because it only went about 4 or 5 ticks, not the distance. It didn't get anywhere close to 66 quarters, which was an ultimate target for the downside. Couldn't break out of the bottom of this range, right? And then she came in, meaning some selling, aggressive selling came in and couldn't get it to go lower at a couple points. So then the market started to aggravate me as it continued to test the 71 quarter, 71 half entry. As you see it come back in. And there's a couple of those. Let me shrink this chart. Let me open up this. This is a 4 PNF chart, but it doesn't have the footprint numbers. So it's a little cleaner. It's got edge zones, right? And it's got consolidation boxes. Really important. If you guys are newer, older, whatever your experience is, you got to look at a range consolidation as a congestion box where a fight took place. There are a couple things that's important about when you read a chart. Number one, what's the market going to look like? Where's the box going to be?
Even quarter.
And then recognizing it after the box is formed. And even though it should be easy to see a box in here before it forms, most people don't. They don't have this visual. So you take this visual and keep it simple. The middle of it's important. Why is the middle of a box important? Because above the middle, more shorts are nervous. Below the middle, more longs are nervous. So if you're short and you start creeping above the middle of a congestion box that you're in, you don't necessarily have to be nervous, but you better know more shorts are being nervous because the box is already defined. There's already so many longs and shorts inside this yellow box, and more are nervous as we get to the top of it. I'm not saying more are nervous back over here when we're trading or even here, but here, after the box has been defined and after you've been in it a while, you know you got open long positions and open short positions. In fact, you could be one of them. And if you are one of them, like me at 71 quarter, I don't want this thing to get above the middle. I got to know where the middle is, and I got to be careful when it creeps back above it. When it gets below it here and it gets back above it in there. And don't be too perfect, but understand that at some point, this is the rest of the day. Not the day, but this could be the breakout the other way than you anticipated. I also got news for you. This market was really close to then going down to the open, which was just really down in here. You know, it was close, just like a athletic basketball, just like an athletic event basketball game. One team was ready to take over momentum and they turned the ball over, totally changed the game.
Even three quarters.
So the market then, the worst thing you could do being bearish in this scenario is to stay bearish in this scenario and still be bearish and still be bearish. And you sell it here, you sold 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 it here. Oh, I caught it. You're still underwater. That ain't trading. That is not trading. That's like going to an amusement park and going on a roller coaster for 4 hours straight. Never stops. That's not fun. You can't stay on a roller coaster forever or you'll throw up. And you won't get away with it. At some point, it won't come back for you. So think of your trades as stupid trades, because if you devalue the trade, like I said in the room today, like I've said in the past, if you have or want a trading career that's made up of thousands and thousands and thousands of trades, why would anyone be important?